Welcome back, my friends. If you are looking for a fabulous yield of over 11% with incredibly low risk, I have got you sorted heading into 2024. This has actually just pinged on my phone a couple of minutes ago that my order has been filled for some shares. Let me tell you what it's all about, why I think this is low risk, and what the yield could be if you were buying today. So, my friends, let's get into it now.
Sachem Capital, it is a mortgage REIT. Now, as you know, I'm not a huge fan of mortgage REITs in general, but hear me out on this particular case. There's a couple of elements here that I think do make Sachem Capital a really interesting case for investment. Now, one of the first points here is the way in which its loans are only 1 to 3 years in duration. And in fact, most of their loans are only a single year in duration. And that's really important. It enables them to reprice as market conditions change, and it also reduces their overall risk. Now, when you think about what this means in the marketplace, most of these loans are going to customers who are simply fixing up or renovating property so that they can then begin to sell it and make a profit. So essentially then we're talking about a loan made against a property which is already in pretty good value, it's already built, it's already constructed, and so these are relatively safe loans as well. Now, yes, lending is always risky, but they manage some of this risk with careful underwriting, so they only, I think, loan up to about 70% of the value of the property. That means that even if the property value did decrease quite considerably, they would still have a level of protection there. So they've built in a margin of safety themselves. Now, they do loan on residential property. They've been more recently focusing on some multifamily and commercial property as well, but primarily the loans are on residential property, which has a much lower chance of default. Now, also in recent quarters as well, they've done some good work in terms of reducing the impact of their non-performing loans, as you can see from the transcripts. They do take a very much a one-off situation, or they analyze every single loan individually, and at times they will also require some additional collateral or personal guarantees from the borrower. Now, what this means is, as long as there's absolutely no catastrophic, and I mean catastrophic, crash in the residential real estate market, Sachem Capital should be okay. Now, they do tend to receive a very large number of mortgage applications, and this enables them to be quite selective in which ones that they pick up, so they're able to sift through all of these mortgage applications and pick those that they believe are going to reduce their risk or lower their risk as much as possible, while also having a strong level of collateral that will protect them against defaults. Okay, so what gives this company a strong level of safety? I think, in my mind, a huge part of this is exceptional balance sheet strength, and also a requirement to maintain a good level of asset coverage so that they can continue to pay out dividends. Okay, so what does this mean? As we know, as a real estate investment trust or a REIT, they have to pay dividends on 90% of the taxable earnings. And so if they wanted to increase leverage, this would create problems for them. Now, what this means as well, when we think about this 150% asset coverage, it means that they cannot issue debt or preferred stock over about 2/3 of the value of the assets that they want to pay dividends if they wish to continue to pay dividends. Now, if you think about this, as 2/3 of 66.7% leverage is very low relative to some of the leverage that other mortgage REITs use. Now, if they were to go over this leverage limit, it would actually prohibit Sachem Capital from issuing additional debt or from buying back stock. And a lot of this is also built into their short-term notes and bonds, where they're limited to 1.5 times asset coverage ratio. And when we think about this as well, they actually have been holding their debt at a lower level than this, so they've been trying to, I think, hold it at about 50% of net debt to assets, and that gives them an extremely low level of debt. It's much lower than other mortgage REITs, but it also means that they have a little bit of a cushion there as well moving forward. Now, you want to know what makes this even better in my mind? We could actually begin to look at the Sachem Capital bonds against the BDC bonds. Now, while they're not a BDC, they have a similar asset coverage ratio of a leverage limit of 150% of their asset coverage. It's very similar to what we see with BDCs. Now, BDCs, I think, is a class more widely covered in this respect. Now, BDC bonds tend to go for about 8% to 9% yield to maturity, but what I'm going to show you today is the Sachem Capital baby bonds are going for about 11% yield to maturity. So in other words, what we're looking at here is a bond opportunity with a very similar asset coverage going for a considerably higher yield to maturity. Now that is interesting, but it gets better. When we think about Sachem Capital, what are they lending against? Well, they've got first lien loans that are going to be backed by actual physical real estate assets. It's backed by something solid. So Sachem Capital, their loans are backed and they have as collateral actual physical property. Now this is fantastic. Now if you compare that to many of the business development companies, some business development companies, yes, some of them will lend and be very specifically focused on the types of industries where they actually have physical assets that they can lend against, but also many BDCs, they will be lending to, for example, a restaurant chain, or they will be lending to, for example, a software company. Now, if something goes bad with those types of companies as their clients and customers, how much money is that BDC actually going to recover? How much of that loan can they recover for their shareholders? And the answer is not a lot, because of the lack of tangible assets that they're lending against. So I think, in my mind, these are incredibly attractive bonds here because of that tangibility of the real estate underlying Sachem Capital's bonds, and therefore underlying the value of these wonderful baby bonds open on the market. They've got 4 of these baby bonds that I think at double-digit yields that I'm particularly have been watching and have interest in. These are SCCD, SCE, SCF and SCG. So these baby bonds, they are listed on regular exchanges. You can buy these with most of your brokerage accounts, so they're very attractive. Now, baby bonds tend to fluctuate more wildly from the par value at which they will be redeemed. They will often also have a shorter period to their maturity date, which is also very attractive. Now, what does all of this mean? I'm going to focus on the investment that I've chosen to make, which was in SCD, and as I said, that just pinged through a little bit earlier. Now, despite the fact that the actual yield, as we saw on the snippet there from Seeking Alpha, it looked like only 7%, that is very misleading, and the reason for this is the actual value at the moment has been trading below what it will be redeemed at. Now that means on top of those distributions that are coming my way, I'm also going to see some of the capital gains there. Now what that means is, instead of just yield, we need to look at the bonds yield to maturity, or YTM. Now there's some simple calculators out there. This is just one of the ones that I found on the Google search that can be easily used. So this was trading for $21.4. It had a face value or a par value of $25. It had 3.0301 years to maturity. It had an annual coupon rate of 6%. That was at $1.50, paid quarterly, which was 6%. Now what that means is, when we compute this out, it comes to a yield to maturity here of about 11.5%. And in my mind, that is an absolutely cracker yield to maturity, given the safety of these bonds, given the durability of these bonds. What does this mean in practice? It means that I can put some money to work in these bonds. It's going to return about 11% per annum, which in my mind is a very strong level of performance. Now, Sachem Capital is a relatively small company, but I believe, based on what they have said, their loans are solid, their business model is a good one, they have taken steps to reduce risk, they are managing risk very carefully, and as a consequence, I believe these bonds are going to be very safe. Now, they're not going to be investment grade rated, but this is where we find opportunity in the market. We find it in these corners of the market which are not well followed, which are not going to be well analysed by analysts at major institutions. Instead, these are, in my mind, quality baby bonds backed by tangible assets that are not being picked up by analysts. I believe they're being mispriced because of this, and as a consequence they're trading below the value they should be trading at, and this represents a very strong opportunity for investors. So look, I've just added today these bonds to my portfolio. I think it adds nice diversification, good income, good capital appreciation, and I believe it represents a phenomenal opportunity today at the end of 2023. What do you think? Is this on your radar? Is this something that you might consider investing in yourself? If not, why not? Let me know in the comments below.